the gap, or the shortage of silver, if you like, is going to continue getting wider as far out as the eye can see.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 22nd through July 29th, 2024, while supplies last. First, we feature backdated 1-ounce gold Canadian maples at the lowest price in years at just $65 over spot. Next, we have backdated gold 1/10-ounce eagles at $39 over melt per coin. We also have 2024 1-ounce Silver Britannia at $3.29 over spot. And finally, we're offering Dealer's Choice Constitutional Silver half dollars at $2.50 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Clive Thompson, formerly in wealth management and Swiss private banking. Clive, thank you so much for joining us today.
Elijah, thank you very much for having me on your show. Good to be invited back the second time.
Well, it's great to have you today. I did want to get an update on the dollar-yen carry trade and kind of the impact of that ending and how it's going to have an impact on the US dollar, US treasuries, and the broader financial system. I know we touched on this a little bit last time we had you on, but could you expand on this for our viewers?
Sure. So I'd like to talk specifically about the hedged yen carry trade. This is a carry trade in simple terms is when a bank or a borrower or a hedge fund borrows one currency at a low interest rate and buys the bonds of another currency paying a much higher rate. So in the case of the yen carry trade, it would be typically a Japanese bank who would be borrowing Japanese yen from the Bank of Japan, where the interest rates were negative until very, very recently. So they'd be borrowing money at a negative rate. They'd convert that money to US dollars and buy US treasuries, which until very recently were yielding about, well, they still are, about 4.25 at the moment. At one point, they could have got 5%. So if they were paying minus 0.1 for their borrowings and earning, let's call it 5% for simplicity, they'd be earning a net 5.1, which is the negative cost that they're borrowing from the Japanese central bank, plus the 5% they're getting on the US treasuries. Now, that's a very profitable trade as such. But of course, if you're a bank, you don't want to expose yourself to too much risks. So you're likely to hedge your foreign currency exposure, that is your US dollar exposure, back to Japanese yen. So for those who don't know about the cost of hedging is always equal to the difference between the two short-term interest rates. So up until very recently, up until a year or so ago, 2 years ago, the short-term interest rate in the United States was about, let's call it 1 or 2%. In fact, it was 0.25% at one point, going back not too many years ago, 2 years ago. So we'll call it 1% for simplicity. And the short-term rate in Japanese yen was minus 0.1 for simplicity. So the cost of hedging was, at one point, the 0.25% that the dollar short-term rate was, and the minus 0.25% or minus 1% on Japanese yen. So it was costing you about 0.5% or 1% to hedge your position. Meanwhile, back then, they were earning 2.5%, 3% on the American government bonds. So they had a clear return, a positive return on the American government bonds of 2 or 3%, and they were paying a hedging cost to protect themselves against a fall in the dollar of perhaps, let's call it 1% for simplicity. So all in all, it was a profitable trade because the interest they're earning on their bonds was greater than their cost of hedging. Over the last year, that has all changed. And the reason it's changed is that US interest rates over the last year and a half, 2 years, have risen to, they're currently 5.25% to 5.5%. They're coming down, actually. I think they're, I haven't got it in front of me, but it's probably about 4.8% at the moment, anticipating a fall on 3 months. And the interest rate at the short end on the Japanese yen has gone up. So what does that mean a little bit? So that means that if we go back to the, let's say, 5.25%, you've got 5.25% minus the, look, let's call it 0.25% on Japanese yen, costing you around 5% to hedge your dollar position. But what are your dollar bonds yielding at the moment? Well, they're yielding about 4.2%. So they're yielding less than the 5% cost of hedging the currency. So they're losing 0.8. But not only that, the yield on Japanese 10-year bonds has risen to over 1% now. So not only are they losing money on the dollar position, if they were to go back into Japanese yen and put it in 10-year Japanese bonds, they'd be earning over 1%. So we've got a difference of they're losing about 1% on the hedging cost and could be gaining 1% on Japanese bonds. So they're about 2% out of the money. So what does that mean? It means that the Japanese banks which have done this, and they've done it really big time across the board, are likely to be thinking about unwinding those positions. Now, it will take a year or two because the amounts involved are pretty stupendous. I think there was one bank announced a few weeks ago that they're going to unwind their position for exactly that reason. They're losing money. And I think their position was around 60, or the amount they said they would unwind was around $67 billion. Now, they didn't specifically say it was treasuries. It could be bonds of any kind, but the assumption is that the most part it'll be US treasuries. But if you replicate that across several banks, I looked up about 4 or 5 Japanese banks that I could find just to see how much they got in foreign bonds. The total between those 4 or 5 banks was about $500 billion. And of course, I wasn't looking at the Ministry of Finance in Japan, who've got a big position, or the Japanese central bank. I was looking at commercial banks. But if you replicate that across many banks, and also there'll be non-Japanese investors who've done that as well, like hedge funds, and they're all of those now will be hurting. And the dilemma they've got is, do we wait and see if American interest rates go down so our trade becomes profitable and we don't unwind anything, or do we start to unwind it? Well, the longer that the American interest rates have remained high, the more it's starting to make the pips squeak. And I think that what's going to happen over the next year or two is those positions will be unwound and the pure Japanese investors will be going back into the 10-year Japanese bond to earn more, which does mean there could be quite a bit of selling of US treasuries coming over the next year and a half, 2 years, I would say. Now, can the market absorb that? Yes, it can. But it's I suppose, yet another sign that the number of potential owners of American government bonds isn't going to be as great going forwards as it has been in the past. And that doesn't exactly help the US Treasury when it's trying to borrow more and more money to fund an ever-growing deficit.
Does seem like an issue that the US has right now, obviously, of this exponentially increasing debt. Now, a lot of people argue that, well, the dollar is still the best currency out there. The U.S. debt is still the most trusted. Your perspective on that, you're talking about how this more selling of U.S. treasuries that could be absorbed, but what do you actually see the ramifications of this for the financial system and the U.S. dollar, the end of the hedged dollar-yen carry trade?
The dollar market is a huge market. It's the biggest market in the world. And it's like a Titanic, or a giant megaton ship. It's very, very hard to turn it around. But I think the tide is turning. And in the last few days, we've seen the dollar coming off a little bit on the future President Trump's remarks. I'm not saying he's definitely going to be president, but that's what the market thinks, because he's going to impose trade tariffs on all kinds of countries. And of course, that's actually going to be bad for the dollar. And so I think it's likely that over the years which come, there'll be less and less international buyers of dollars, partly because of the weaponization of the dollar. America's allies will still hold treasuries, but there are many, many countries who, they're not an enemy of America, but they're not exactly an ally either. And they think, well, they're weaponizing the dollar against the Russians and maybe the Chinese, and who's next, and maybe we're next. So I think the willingness to hold all of your reserves, or a lot of your reserves in dollars, is going to go down. And that means that the requirement for the Treasury, the US Treasury, to fund itself will have to come more and more from domestic US investors, i.e. US pension funds, US banks, US money market funds, and those sort of things. And there's going to be an appetite problem at some point, because the US government is having to borrow faster and faster to meet their official budget. Their official budget is a budget of a growing deficit, and it's a growing deficit which is growing faster and faster, which causes the level of American debt, the government debt, to rise faster and faster. It's rising against GDP. In other words, the level of debt is rising faster than the economy is growing. And it's quite some time ago, a long, long time ago, past the point where one could say the level of debt is sustainable. We're in unsustainable territory. So that debt is getting bigger, and it's being compounded by the rise in American interest rates, because a lot of the debt money they've borrowed was borrowed 5 or 10 years ago when interest rates were very, very low, 1 or 2%. And some of that's coming to maturity, and quite a lot of it's coming to maturity. And as it matures, it will have to be rolled over at the current rates of interest. If you're talking 10-year bonds, 4.25% at the moment, which is a lot higher than the 2 or 2.5% that they were borrowing at 5 years ago. So what does that mean? It means that the interest the government has to pay on the national debt is rising pretty fast. I haven't got the figures precisely in front of me, but a couple of years ago, the interest cost was about 7% of the expenditure. I think this year it's about 14%, and I think it's set to grow quite rapidly up into the 20s in the next couple of years. By the time we get into the mid-1930s, the interest cost, if all things are equal, is likely to exceed 100% of their tax take. So whilst it's still the government, they can get the Federal Reserve to print unlimited amounts of money. At the end of the day, if this was a family whose credit card debt had interest on it, which was higher than the income the family's earning, it wouldn't take long before the banks would say, we're not going to lend you anymore. And I think that's the risk that we have with the Treasury market. Not that people will say, I won't lend you anymore, but certainly when they'll say, there's a higher risk now and I want a higher interest rate. And you get to a point where that interest rate is unacceptable or unsustainable, and then the Federal Reserve will be obliged, I think, or forced or invited to step in and buy those government bonds. In other words, effectively lending the money to the government itself. And where does the Federal Reserve get the money to lend to the government? Well, it has to print it. That's the other side of the coin. The liability is the money they printed. The asset are the bonds they buy.
When it comes to the impact of this all in the markets, it seems like if we're seeing a devaluing dollar, the markets across the board are probably going to go up. And one of the things we've been seeing, and you've pointed out in one of your recent articles, is that all markets across the board seem to be rising right now. If you consider the S&P and also gold, they have outpaced experts' expectations in recent years. So your perspective on that, why we're seeing this melt up right now, and do you expect that to continue?
Well, we've been seeing the melt up since the COVID crash of March 2021. So it's been going on non-stop and faster than anyone could have imagined. Every year they come out with their forecasts of where the stock market's going to end up, and it ends up much higher than they forecast. And the reason for that is there's a lot of money out there. I mean, if you think about it, when the government borrows money, the government gets poorer, and someone gets that money, so someone gets richer. Now, it may not be the first person they give it to because they're giving it out as social security or salaries to the government employees, but those people are spending the money on something, and it goes up the value, up the chain until it ends up in the hands of the wealthiest people. Could be big corporations or foreign governments or whatever. But whoever's got that money, look at the Treasury markets. Some of them are saying, well, I'm not happy with my 4.5% on Treasuries. I actually want to get a bit more. I want something which is more robust, which is going to protect me more against inflation. And that's why they're heading into the equity market. That's why they're heading into gold. That's why they're heading into silver. And of course, we've seen Bitcoin have its massive rise as well, for not necessarily for the same reasons, but it's certainly been a factor. And of course, tangible assets of all kinds are attractive, especially the ones which are rare and hard to get. So if you're an extremely wealthy person who likes to collect properties by the sea and rare works of art and so forth, those kind of things are going through the roof because there's more and more wealthy people who've got more and more money, and they're all bidding against each other for these rare assets. It's not going to affect the price as much for the man in the street, because a lot of what the man in the street consumes are things which are made by robots. And you can increase the supply of a lot of things quite easily without incurring much extra cost. The real costs of production are things like the marketing, like the research, like the transportation, and that sort of thing. But whether you make 10 pizzas with a robot or 100 pizzas with a robot, there's a large component of that manufacturing process which is not done by human hands anymore. And so even if the labor costs rise, maybe that's only 10% of the cost of that particular item. And therefore, if the labor costs go up by 25%, it only increases the cost of the item by 2.5%. That's why the inflation is not reflecting the true level of monetary increase. It's not reflecting the increase in the level of government debt. But as the government borrows more and more, it's getting poorer and other people are getting richer somewhere, and that's pushing up the stock market. Do I think it will continue? That was your other question. Do I think it will continue? These things continue until they don't. One thing which will always stick in my mind is 1994, when stock markets looked overpriced. They looked like it was due for a large correction. That I can't remember what was happening with the dollar, but something was going on with the dollar. Maybe interest rates were rising. That's what it was in America. So everyone was pretty bearish in 1994 because stocks were overpriced. And yet they went on to have one of the biggest and longest rallies in all of history, certainly the longest I've seen in my lifetime, which lasted until 2006, 6.5 years. So they went from overpriced to overpriced to overpriced to overpriced to extremely overpriced to outrageously overpriced before it finally popped. So this can happen again. And we mustn't forget that we're now in a very different world from 1994, where there were actually humans who could look at these things and say it's overvalued. I do remember cutting out and sending to my clients back then cuttings from the Wall Street Journal, which said, this is crazy. How crazy can it get? These new companies are popping with .coms and so forth. They're popping up like mushrooms in the night. And how can they possibly survive? It's how ridiculous it is. You had the clients all clamoring on the phone to get the next .com. That was then. But where are we now? This is all done by robots. So about 80%, they say, of the trading on the stock market is done by robots, not by humans. And those robots aren't thinking. They're just saying, if it's in the index, we buy it. So when, for example, someone says, you'd like to invest some money, and your banker rings you up and he says, well, I've got this really good fund, but you can also buy some Nivea. You'd probably say, no, I'm not going to buy Nivea, it's too high, I missed the boat. But what's this fund? And he'll say, it's a really good fund, it's gone up by 10%, it's run by a really good firm. You say, great, I'll have some of that. That sounds like a good idea because it's beaten all the other funds. But that fund owns exactly the same stocks that you didn't have the guts to buy in the first place because they were too high. So what happens? The fund gets your cash, the fund piles into those stocks, and the fund has to do it because it's not even thinking about it. It might be an ETF, for example, where it has to follow the index. So that's what's pushing the stocks up, and that's going to continue to push up stocks as long as there's confidence in the public at large to keep putting money into funds and taking it out of their money market funds and putting it to work in that kind of way. And the more people worry about the level of government debt, the more they worry about the inflation rate, the more they're going to look for those kind of inflation hedges. So yes, it can continue for a long time, but we mustn't forget the world is also full of surprises. You never know when you're going to get a black swan. And that's, when you ask me how long, I'll tell you, it'll last until we get a black swan. And what's a black swan? It's an event we're not expecting to happen, but these black swans come along every now and then. It could be a war, it could be an earthquake in California, it could be a pandemic, it could be a recession, it could be civil unrest, it could be political turmoil. We don't know what these black swans might be, but there could be something comes along which makes people nervous. And if they're nervous, they stop investing in the stock market. And then someone says, I'll sell that nice fund I bought because I'd rather have it in the house next door or that condo in New York or whatever he decides to buy. And little by little, the prices start to slip. And then suddenly there's a rout because all the machines are selling it all at the same time. And they don't care. They have to sell because people are redeeming their units in the fund.
When that occurs, often people move towards precious metals, at least over the long term, during a crisis, it seems like precious metals are, real assets that people flock to. I did want to get your perspective on silver in particular. I know we've talked in the past about gold, but you did recently write about silver, how really there's a silver deficit, right? Silver supply is falling and industry is using more and more of it. And also, there's more demand from investment and all of that. So your perspective on the supply demand dynamic, and if we're already seeing this deficit, then what is the silver market going to look like when people start piling into real assets?
Yes, if you just give me a second, I think I can bring up a slide to share with you. We're looking here at a chart over the last decade of the amount of silver which has been mined. And that is the green line, which is sloping gradually downwards. And it's in millions of ounces. So it's gone down from about 950 in 2015 to from about 900 million ounces a year being mined to the current just over 800 million ounces a year being mined. So the amount of silver being mined is dropping a little bit each year. And then we've got the blue line, which shows the consumption of silver for uses like electronics and so forth, the normal uses of silver, not including the manufacture of silver coins or silver bars. It's basically the manufacture of any industrial use, whatever it may be. And we see that back in 2015, it was around 750 million ounces being used compared with the 900 million being mined. So they had less being used than mined. And if we step forward to the year 2022, that was the first year in which the amount of silver being consumed by the industry exceeded the amount being mined. And 2023, the amount being consumed went up a lot. And the reason for that in 2023 was the electronics industry consumed an extra 20% of silver compared with the year before. And the subcomponent of electronics industry is the photovoltaic area, which consumed, I think it was 67% more silver in the year. And those numbers are set to continue, at least according to the forecast from the Silver Institute, so much so that the small gap which we had in 2022 became a slightly larger gap in 2023 and will become a very large gap next year or this year, if you like, according to their forecast, 2024. And it's going to the gap, or the shortage of silver, if you like, is going to continue getting wider as far out as the eye can see. The reason for that is we're not going to have less electronics on the planet. We're not going to have less photovoltaic on the planet. So just talking about photovoltaic, that's people often think about solar panels on your roof, but it's not just that. There are so many household items and other items which have got photovoltaic cells now, ranging from battery chargers to Internet of Things devices. Almost everywhere you look, you can see these solar panels, security cameras. So there's more and more of them going into electronic devices. And that's consuming a lot of silver and pushing up the consumption of silver. So that's not going to go away. Will the supply of silver increase? It could do, but it's not going to be very fast because most of the silver is mined as a byproduct of other metals. And when you're opening up a pure silver mine, it can take a number of years. So that downwards trend in the mine production of silver is probably going to continue along those lines for a while. And the upward trend in consumption is likely to continue. So if you can see the chart, the blue line heading upwards, we are already well ahead in terms of the shortage getting bigger and bigger, and it's going to get bigger and bigger. Now, the difference between the shortage of silver, where is that supplied from? It's supplied from recycling. But the way you get recycling is you've got to have a higher price to get your granny to take her candlesticks down to the pawn shop and have them melted down. I'm certainly not going to be taking my silver coins to the coin shop and having them melted down, but some people might be if they're desperate for the cash. But the higher it goes, the higher the price goes, the more likely they'll do that. So to get that silver, to meet that shortage, there's got to be more recycled silver, which in my mind means that the silver price probably over the next few years will probably head upwards. How high could it go? Well, the previous peak was $50. It's below $30 as I speak. I think that it could easily go past the previous peak, probably not this year, but certainly in the next year or so, maybe 2 years, 3 years, that peak of 50 could be passed. That's not advice. It's just my personal opinion, because when you have a shortage of something, the price has to go higher to either reduce the demand or increase the supply. And I think that's what's going to happen here.
Now, with respect to miners as well, I know recently we have seen underperformance from miners, and you've written about this. Your perspective for both gold and silver miners, why they're underperforming, and what is your outlook for them going forward?
I think the reason they've underperformed for the last decade or more, and it's been a very long period, in fact, if you look back over about 11 or 12 years, gold and silver miners are all down from the level of 10 or 11 years ago, and silver and gold are both up. I think the reason is that people have become quite disillusioned with gold and silver mining companies, which probably were a bit overpriced back then. And the rest of the stock market has been rising like a rocket, and people have been withdrawing money from their, certainly last couple of years anyway, from the rather stale and boring gold and silver mining companies, which were really doing nothing. The prices weren't going up. And they've said, I'm going to buy something which is actually moving. And we all know the kind of things which are moving. So the money is flowing into the hot stocks and the ones which are moving up. And that might well continue. But I'm going to tell you a reason why, even if it does continue, I think the gold and silver stocks will start to rise in the near term. And that reason is mergers and acquisitions. If you're a large gold mining company, there's never been a better time to buy one of your competitors, one of your smaller competitors, one of your cash-strapped competitors who've got lots of gold or lots of silver in the ground, but don't have the cash to pull it out. And if you can buy a competitor who's somewhere within easy reach of your existing mines, it makes the logistics of moving equipment around much easier. And why is it attractive? Well, it's attractive because gold and silver prices are both up a lot over the last year and a half, 2 years. But the mining stocks they moved up, but nothing like the gold and silver price. So you're getting a lot more bang for your buck if you buy one of your competitors now than you would have done a year or 2 years ago. And the other factor is, as the gold and silver prices rise, it means that these junior gold miners who don't have the cash to do much mining, they do some, can't get the extra gold. The gold which is in the ground suddenly becomes viable. It wasn't viable at, let's say, $1,600 an ounce. It was perhaps only just viable at $2,000 an ounce, but at $2,400 an ounce is very viable. So these smaller mining companies with a lot of gold, a lot of silver in the ground, or the potential for it, are becoming rapidly a lot more valuable as the gold becomes viable to get out of the ground. But the share prices haven't moved enough, or they move up a bit, but hardly moved. So the large mining companies are going to be looking at this. They've got to be looking at it and saying, now is the best time to snap up reserves and increase our potential reserves. And I'm not going to say the names of specific companies here, but I was looking at one very large, very well-known, it's in the top 10 anyway, let's say, mining company, who says it in words of one syllable in their annual report, that over the years, they've been increasing their reserves. They have far more reserves today than they had 10 years ago, and they plan to keep doing that. How do they do it? The only way to do it is to buy other companies.
Well, it seems like it'll be definitely looking forward here in the precious metal markets, in the mining companies as well. It'll be an exciting time ahead. If people are interested in learning more and they'd like to follow your work, I know you're mainly on LinkedIn, where you publish articles very frequently. Can you share with us a bit about that?
Sure. I'm writing on LinkedIn a couple of times a week. I pick a topic of interest. Sometimes it's quite weird stuff. For example, I once published a story about a man who killed himself in a vat of boiling beer after losing a ton of money in the stock market. And that happened in the dot-com bubble of 1904, which wasn't a dot-com bubble, of course. It was the railway bubble. But it was an interesting story where a lot of people were shorting one particular stock because it was going to the moon. And it ended up with the buyers of that particular railway company. There were two buyers, two major companies wanted to own it. Between them, they owned more than 100% of the stock, and the shorts were getting squeezed, and it was very easy to do 10 times leverage back then on your shorts. And this guy lost his shirt. He was a multimillionaire, lost everything, and killed himself. That's kind of it's a true story, but it's quite a interesting anecdote to tell. But more often I'm writing about things like the presidential race or the viability of the central bank, because they're getting more and more deeper and deeper into problems with their losses. And of course, the direction of the dollar, the direction of the gold, silver, and I've written once or twice about Bitcoin, but I think a lot of people don't like me when I do that, because it brings out a lot of hatred from the gold lovers, and if I write about gold, it brings out hatred from the Bitcoin lovers. But I don't see why you can't love them both.
Fantastic. Well, Clive Thompson, formerly in wealth management, thank you so much for joining us today. Before I let you go, any last thoughts you'd like to leave with our viewers?
Well, if anyone's got any questions, you're welcome to drop me a note via LinkedIn. That's the only place I communicate. And I'll be very happy to answer your questions. I'm getting 2 or 3 questions a day from previous podcasts and videos. I'm quite happy to answer any questions you fire at me. I might not be able to give you specific investment advice, but I might be able to help you find your way to get the answer yourself. So don't hesitate to write to me if you have questions.
Fantastic. Clive, thank you as always for your time today, and God bless.
Thank you very much, Elijah. And thumbs up from all your listeners, please.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 22nd through July 29th, 2024, while supplies last. First, we feature backdated 1-ounce gold Canadian maples at the lowest price in years at just $65 over spot. Next, we have backdated gold 1/10-ounce Eagles at $39 over melt per coin. We also have 2024 1-ounce Silver Britannia at $3.29 over spot. And finally, we're offering Dealer's Choice Constitutional Silver half dollars at $2.50 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.